It's said that George Soros possesses a sort of speculator's spidey sense for when markets are poised to take a tumble. The Hungarian investor starts to feel a sharp pain in his lower back. But for those lacking such financially attuned vertebrae, a better early warning sign might be able to be found in Japan. Over the last two stock market bubbles, the dot-com bubble here and the subprime bubble here, a curious pattern has emerged where Japan's Nikkei index has hit its peak several months before the US S&P 500. This is counterintuitive because the US economy is larger than Japan's and its stock market is more liquid and internationally owned. So that should mean that it would lead the rest of the world's markets rather than following. So what could explain this pattern? One theory is that the US has a very, very sizable current account deficit, which since the 1980s has seen the country become the world's largest debtor, as we can see in the chart here. Simply put, this means that the US economy is unable to fund itself, and so it has to look to foreigners to plug this gap. Japan, at the same time, has jumped at this chance, becoming the largest US creditor relative to GDP, as we can see in this chart. And so its overall net international investment position has risen from 10% in 1989 to over 70% by 2014. So as a result, global equities are increasingly attuned to the whims of Japanese investors, because they are now the world's largest global savers and investors in markets. So as an illustration of this, the influence can be seen by redenominating the S&P 500 from dollars into Japanese yen, as we can see in this chart. So now the pattern changes. Rather than peak ahead of a crash, this actually shows that the Nikkei is moving in near lockstep with the S&P 500 in yen terms over the last 15 years. And this closely tracks Japan's foreign investment position as it steadily increases over this period. So, simply put, when Japanese investors venture abroad for returns, they sell yen to do this. This weakens the currency and it drives up foreign markets. And when they pull back, they repatriate assets and the yen strengthens, so markets dip. Now, this is where Mr. Soros's back might start to tingle a bit. This week, the yen hit a 17-month high against the dollar, with many expecting that it could actually strengthen against US currency further. Now, the last time the Japanese currency pushed the dollar back below the 100 yen level, the S&P 500 was trading at around 1650. If we extrapolate, this would imply a 20% potential tumble for US equities if this happens again.